and thank you for your presentations. Just this package from the Commission didn't obviously come out of the blue. So on the one hand, we have the ECB saying it's up to the banks to deal with the NPLs, and then on the other hand, we have the EU Commission. So they just happen to bring forward proposals to facilitate the vultures and accelerate enforcement of loans secured by collateral. But what coordination has there been between the ECB and the Commission on this issue? Maybe this is the first one.
So thank you for the question, and to be honest, there are two aspects to the response. The first is in terms of process and governance and coordination, and there was indeed a timing difference, meaning the SSM were keen to act quickly and on a wider scope and have supervisory measures which were more based on judgment, bank specific, about the banks working out the NPL strategies, as you suggest. The Commission, sometime after that process, I think came to the conclusion that actually they believed it had to be a regulatory response, meaning a change, which was narrower in scope, which then opens up a discussion as to why it only applies to new lending, and it will be quite a few years before it takes place. So essentially, that's a process answer. And then in terms of substance, there's the issue of having a wide range of toolkits, first of all for transparency of risk. So you do want to change in regulation, you want all banks to abide by the same rules, and also you want to signal that well in advance, so there's no surprises. So that, if you like, is the Commission proposal, but just to reiterate, it's on new lending now that becomes non-performing in the future, so it doesn't relate to the current stock. And the SSM measures are very much part of the supervisory toolkit, which is now communicated better and clearer to the industry. So there are two different, I view them as complementary aspects rather than contradictory.
Okay, and what input did the central bank and the department have to it? What input have you already made to those proposals?
I can talk to the SSM and if you want to talk to it.
Yeah, I suppose the first comment I'd make, Deputy, is that obviously the Commission has the right of initiative in relation to proposals that they bring forward in relation to directives. So it's the Commission who decides to bring forward these proposals, and then they get debated and discussed by the Council, and obviously also because it's a co-decision procedure, they will then be discussed by the European Parliament. And I think, quite honestly, where the Commission is coming from in all of this is obviously trying to learn the lessons from the financial crisis in relation to the fact that the banks were under-provisioned for the stock of NPLs in the last crisis, and then also trying to ensure that they deal with their stock of future NPLs in a faster, more efficient manner, given that there would be a view that they didn't really deal with this issue very quickly during the financial crisis.
The input of the central bank and the department into it, maybe just...
So to be clear, the SSM supervisory expectations you referred to were a core part of that, with Sharon Donnery chairing the NPL task force, and then at a working level as well. But as you correctly stated, our view remains that the banks need effective strategies with a whole range of solutions, with a big focus on restructuring, borrowers engaging, the banks engaging, and coming up with sustainable solutions. So we view that actually we've been doing that for the last 5 years in Ireland, and we have been acting through the SSM, making that apply across the whole of Europe, and then taking obviously best practice from other countries too. So we've been driving that piece, and then, to be honest, we see from a central bank point of view, we see it very early days in terms of a Commission proposal, in terms of the longer term measures, and I believe there's only been one meeting. So they're very different. One has, 5 years of history behind it, the other one has just started, in my view.
And what input do you plan to have in the future? Yeah.
So,
well, we obviously, as part of the working groups, it's all member states. All member states have an input into the legislative proposals, and there is also in the room there's the Commission and there's also some observers from time to time. But they really are negotiations amongst the member states, led by the presidency, with the Commission in the room as well. And then obviously it goes, subject to agreement, it goes to a further stage with Council and Parliament.
Okay, just on in terms of what difference this would make if we were to have a crash again like we experienced before. You know, if there's an economic slump, people are going to lose their jobs and maybe be unable to pay their loans. So how does a bank having more reserves change any of that? I suppose, is there anything in this that will protect the homeowner? Or the landowner or whoever it might be that has the loan?
So you're right, the focus is indeed on avoiding or mitigating the impact of a next crisis. And the key point is to make the risk recognition earlier, which is very similar to the IFRS 9 discussion recently in the new accounting rules. And also to very transparently differentiate between banks' activities so that they recognise the risks in advance and build up those reserves so that they make sure the resources are available to deal with the initial problem, which is to prevent the build-up. So if we look back what happened in Ireland, of course you have the economic crisis, you have the people not being able to pay, you also have the factor of the sheer scale meant banks were not dealing with it in terms of operations and good due diligence and having processes that you could quickly intervene early with the borrower to turn the problem around. The idea of these measures is to make it essentially punitive for the risk to build up, to change the dynamic from people wanting to hold on to problems and hope the property market turns around, to mitigate that kind of incentive, to actually make it clear that the costs come earlier so that they need to deal with it and engage with the borrowers at a very early stage. So before people even get into the later stages of arrears.
But surely that would mean that homeowners or landowners would lose their assets even quicker?
Well,
if you're saying to the banks to deal with them earlier, that people wouldn't be given a chance to recover?
Yeah, so absolutely. So by actually what we found to be most effective is early intervention in the sense of what can the borrower afford, resizing debt, what arrangements help in the short term whilst negotiating a longer term solution. So I didn't mean to allude to deal with in the sense of the collateral. I'm really fixed on restructuring and working out the problem. And the earlier you intervene, the better.
And I suppose I'd maybe just add that obviously our experience with the global financial crisis was that non-performing loans tended not to be resolved very quickly. And so the stock of NPLs grew, and that itself has significant impacts for consumers. It locks up capital within the banks, and it means it's more difficult for banks then to lend money to new customers and new loans because they have to keep so much of their capital.
No, I completely understand that this conversation is a bit like an exercise in teaching how the system works. But what I am concerned about, if this is an extra pressure on banks and all of that to see, and I can see the merit in it on a macro level, but what I am afraid of is that, I suppose, how are we going to make sure that the banks would actually have proper and meaningful engagement with people at an earlier stage, so that that's done rather than what happens at the moment in terms of avoidance and people not being able to contact their banks or not having any meaningful discussion on it.
And I think that's a very fair question. I think one aspect of this proposal is obviously the ACE proposal, and what's interesting about that is that essentially the business borrower, because it won't really impact on consumers in terms of their principal private dwelling, but business borrowers would agree. Can
I just ask you there, does that apply to, say, to land as well? So in the case of farming, in terms of that being their main asset?
It would apply, as I understand it, to businesses above a certain threshold, so that would include maybe large farms.
Who are not categorised as a consumer.
Yeah, so generally I think farms, for example, taking farms as an example, I think farms may be valued at less than 3 million would be regarded as small farmers, through a turnover of 3 million would be regarded as consumers. So there's thresholds that would beyond which.
So they wouldn't be affected by it at all, because there aren't that many farmers in the west of Ireland with a turnover
No,
of 3
I don't think
million.
there are.
So,
No. So
okay.
this is really, the ACE proposal is geared towards business borrowers. But I think what's important about it is that business borrowers and the banks would be agreeing in advance what would happen if the loan went bad. So you agree up front that certain collateral would be called upon. And I think in terms of trying to provide greater information and transparency, I think that could be a good thing, so that everyone will be clear about what are the consequences when some of these loans go bad in the future.
But it wouldn't affect the behaviour of the bank in terms of their behaviour towards the consumers.
Well, I think it might, in the sense that the banks are probably going to be more cautious because they know they're going to have to hold more capital.
Okay, and just maybe on that, given the stake that the people have in the banks, what are the implications for the capital positions of these banks if this was to be implemented tomorrow? So I suppose, how will the new provision interact with the capital requirement rules that are already in place? And I just want to ask you the impact on interest rates, and I'll finish then. Thank you.
Deputy, I'll take that in summary, and Adrian can correct me if I'm wrong, but broadly, because this is to do with either newly originated loans after 2018, which then have to turn bad and then have to get provisioned over a period up to 8 years if they're secured exposure. The impact won't be immediate, particularly for the Irish banks, because the new non-performing loans at the moment are quite low, but it would have an impact if there was worsening economic conditions after it's introduced.
And therein the problem lies. If you see an increase in interest rates, which could cause, obviously, us to be in a difficult situation, to get our people who have loans in a difficult situation in terms of them turning from performing into non-performing. I suppose we need, as a committee here, to look ahead at what may happen and what restrictions will then be in place because of this.
One comment in relation to that. Obviously, this is to do with new lending at the moment.
Yeah.
So a lot of that new lending, then, particularly on the mortgage side, is also covered by the macroprudential limits. So we are in a different position where the new lending is expected to be I suppose, caught and better than it might otherwise have been.